Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. As you can see, I'm broadcasting from Singapore this week, where I'll be for around 2 months, and I'm looking forward to that, to use the opportunity, being in Asia, to pull in our experts more directly here more often, and especially given our overall presence here in the region. So before I get into that, and I'm joined by Peiqian Liu today, our Chief China Economist, before I get into our questions, since I've spoken to you last, having taken a week off, with last week being hosted by Ryan Dangerfield, we've had some pretty seismic shifts in the market, mostly from the rate side of things, but also in FX commodities. Now, we'll leave commodities to the side for the moment because that volatility is expected to stay and is based on things that are relatively unpredictable at the moment. Obviously, the conflict in between Russia and Ukraine. But we'll talk a little bit about the move higher in U.S. yields, which is a near historic move in both speed and veracity. A lot of that stems from Powell and from the Fed meeting, where the Fed meeting was pretty hawkish, and then every time he speaks, he seems to get more and more hawkish every time. So that has us thinking, or at least markets thinking, that he's admitting that the Fed is behind the curve. We've priced in the potential for 50 basis point moves at the next several meetings potentially. And we think that's certainly possible. The market continues to think that they're going to go 50 basis points. Even previous doves have started talking about that. And if we get one of those in May, wouldn't be surprised if we got one in June. And that's what's really been behind these massive moves. But what do we think of all this? Well, first, I do think the front end of the US curve has more room to go. But as we look further out, we actually are starting to see a little bit of value here. And I mean, let's put it this way. We think that there's a potential for the US rates to peak this summer because it seems implausible to me, I should say, that the Fed can soft land this economy in a stagflationary environment near historic, or in modern history, historic inflation levels, with growth already decelerating. Now, that doesn't mean growth is particularly slow, but you have decelerating growth, stagflationary environment, Fed aggressively hiking, potentially 50 basis point increments. So I think the market is going to start to price in, or investors start to become more and more concerned about a recession. Now, we've seen some of these concerns in the past, but mostly they have been in the out years. But if the Fed gets very aggressive at a time growth slowing down, we think that those concerns become more prominent, and the market or investors can start to think that it's going to happen sooner rather than a couple of years down the road. We've seen that through flattening curves, but also we think that if that continues, that actually should help anchor longer end yields, because that's looking at further down the road when that recession may come, and the fact that the Fed may be cutting rates, which is already being priced in for like that 24 area. That should continue. That should help start to re-anchor some of those yields further out. So it's the first time we've actually thought that there could be some fair value in yields, not just in the US based on this idea, but also in the UK, which has had the benefit of lowering borrowing projections as of late. And we never really thought the Bank of England cycle would be as aggressive as the Fed's anyway. And we do think 10-year yields can move a little bit higher, but we also are getting a little bit more closer to neutral on that, at least, with much of the low-hanging fruit being done. So what am I getting at? We've had very large rate moves. We don't think they're quite finished, but we do think that we're starting to see some value here in fixed income, especially at least in the US curve. And just quickly before I turn to the region here, we do think that you can translate that to FX markets. We've been long dollar against the yen, but we've taken that off, thinking we've seen a big move. We do think the euro can depreciate against the dollar still, as we could, again, have a little bit of pricing. We start to look towards those 50 basis point hikes, but we're very watchful of this potential recession theme, because that could change the narrative around the dollar as well. So all that said, I'm going to switch gears now and turn to our Chief China Economist, Peiqian Liu, who for once I get to interview in person. So this is quite fun. Peiqian, so you heard me go through the stagflationary environment, and as we know, much of that stems from supply chain issues, right? I mean, that's not a new story. And that's only been made worse by what we're seeing here in Russia and the Ukraine. But there's new threats potentially from the region, namely what's going on, the increases in COVID from China. We're getting headlines of regions or cities being locked down. Given the importance of supply chains into the stagflationary environment, how worried should we be about that?
Thanks, John, for having me physically in a meeting, which was a very good experience. So starting from China and the supply chain, I think the supply chain disruptions kind of rhymes with China's domestic COVID outbreaks. The latest one we have seen is the biggest ever in terms of scale since the Wuhan outbreak. Just in terms of numbers, 28 out of 31 provinces in mainland China have discovered COVID cases of various degrees. But to put it in another picture, the COVID management policies has changed marginally. The areas under complete lockdown for the past 2 weeks at the peak of the pandemic covers only about 30% of GDP, which is less compared to the degree or the scale of the outbreaks. So that, I think you know where I am leading to, especially in Shenzhen, Shanghai, the manufacturing hubs. They are actually under targeted lockdown, closed loop management, which try to minimize the disruption to supply chains. So from that perspective, I think I'm less worried about the disruption to supply chain. It might be a very deep disruption, but for a very short period of time. But I'm more worried about consumption because in order for consumption and service sector to recover more sustainably in China, we definitely need much more relaxed COVID policies and much more consumer confidence. So we have not seen that yet. To put it in more higher frequency data we have seen in the past 2 weeks at the peak of this outbreak, shipping index from Shanghai and Ningbo, the manufacturing hubs have not been going up, which means they are still steadily improving. But property sales and higher frequency restaurant bookings have been showing a very significant drop. So that's our concerns. So overall, in terms of the broader picture, we think that our estimate shows that there will be around 0.3 to 0.5 percentage points hit from this latest COVID outbreak, still significant, which puts China's growth still below its long-term potential growth path. So our forecast for Q1 GDP is not optimistic yet, still at 4.7%, below the long-term potential of 5 to 5.5.
Okay, so I'm already worried about growth slowdowns in the US and stuff from the Fed. Now I was thinking about supply chains, but as you said, there's clear now translating that into Chinese growth also. So, the 5.5% is their GDP target. Given all the things you just went through, the wide range of domestic and external threats, but in addition to what you said about COVID and the property sector, we've had a lot of regulatory issues, tech crackdowns, and that kind of stuff. So, do you think that 5.5% GDP is achievable? I mean, you mentioned first quarter and second quarter, but over the longer term, what's your thoughts around growth for this year?
Well, to begin with, I think the 5.5% growth, about 5.5%, was an ambitious target when it was first announced because it was much higher than the market expectations or forecasts, which currently sits at around 5%. So in order for that in order for growth to come back up to 5.5%, I think we need a much more stronger policy settings. So, but given that China has seldom missed its GDP target, so there are definitely room for some outside surprises, even though we are not in a very good growth momentum right now. So there are actually 4 areas of outside surprises that we might be seeing throughout the year into the year end for China to be closer to its 5.5% growth target. The first one being COVID policy. So even though we're still seeing that China is sticking to its zero COVID strategy, we have seen some tweaks in terms of the details of policy implementation in this outbreak. They have changed their testing regime, and they have already executed targeted lockdown instead of massive lockdowns, which are baby steps in the global context, but it's moving forward. So it's hopeful that China might be relaxing COVID strategy domestically more or faster than our current projection, which will only happen end of the year. So we think there is chances that China might be bringing forward reopen domestically to boost growth, especially for service sector employment to recover. The second area of upside surprise, in my view, might come from China's fiscal policies. Even though China did not increase its fiscal deficit target in the government work report this year, but it has maintained a very strong support to infrastructure investments. So I think in order to support a strong growth momentum, China might still continue to lift its traditional level of infrastructure investments to front load the 5-year plan on new infrastructure to boost growth rates this year. And a third area of upside surprise, which I think might come from industrial productions, because government work report this year notably did not include any energy consumption reduction plans. They used to have a target of 3% reduction for them to keep in line with a long-term decarbonization goal. But missing that out gives a signal that energy security, energy supplies, and smooth functioning of supply chain probably takes priority this year. So we are projecting a faster growth in terms of industrial production for later this year. And lastly, to achieve 5.5% in our view requires a lot of policy coordination and external stability, which I think is still ambitious based on what we see right now with Ukraine-Russia crisis, and that China is still not seeing stabilization of domestic sentiment over tech crackdown and property sales. So we'll see how it progresses throughout the year, but I'm hopeful that China's growth might be coming up to its long-term potential of around 5.3% by end of this year.
Okay, those are certainly some important things to keep an eye on. Thanks, Peiqian. Appreciate you joining us today. It's fun doing it in person. So that's all for this week that we have. Next week in the U.S., we've got inflation data, and I'm watching consumer confidence. Peiqian mentioned that for in China, but for us, we've seen consumer confidence declines in the U.S. Based on the high inflation readings and the tax on consumers that is representing. We also have the U.S. jobs report. Highlight for the UK is GDP data. Eurozone also has inflation data. And here in the region, we'll be getting Chinese PMI data. So lots to look forward just even in the short term here in the region. So good luck, everyone. Thank you for joining us, and I hope you have a good week. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.